Okay, so here's where we left off last class. So, any questions about the material that we've covered so far? Any issues that you've run into with the technology? Anything that you want to ask about the class? So we have a few of these cases associated with inventory, and we're going to talk about goods in transit. And so you'll have a couple expressions, and I know we talked about it briefly, but as much as I can remind you, I'm going to. FOB shipping means the goods. Uh, say between the legal goods are legally transferred to the buyer when the goods leave the ship. Could call it the selling company because sometimes shipping and selling can be different. Typically, the buyer pays for the shipping costs through its own vendor. Generally speaking, somebody will sell you something and they'll tell you if you want us to ship it, it must. Usually speaking, supplier. So typically, that's why the buyer does that type of thing. But the seller does not want to take responsibility for the shipping goods handling the material, right? We've all seen tractor trailers overturned on the highway, et cetera, right? Generally, they're covered by insurance. But if you don't have to deal with it, why would you want to? So what does this mean? This means that the buyer has to record the inventory when it ships, and the seller can record the sale when it ships. FOB destination. Exactly the opposite case, and this means the goods are legally transferred to the buyer when the buyer receives them. And I add accepts because a lot of times if the buyer has an issue with the goods, they can outright reject them. And the seller will usually charge the buyer for shipping. They'll usually pay it initially or offer it on its own trucks. This means buyer does not count the inventory until it is accepted. Seller records sale is accepted. And they record the inventory as though it's in their inventory. And you say, well, why does any of this matter? And it really matters around the end of the, think of the timeline. Here's the end of the period. And then you have this shipping, and so if I send something FOB destination, if I'm the seller, I need to record it. It has my claims for it. Otherwise, inventory is understated. It's sold is over. This is where it becomes very important. And in the same regard, if I send something FOB shipping point, let's say I send it, both of these on 12/30. Sort of before the year end. The two, I must include seller excludes inventory. Otherwise, inventory is overstated. And cost of goods sold is understated. And if you've taken audit, or if you haven't taken audit, what they'll do is they'll look at those and they'll say either they're properly excluded, improperly excluded, properly included. Consigned goods. These are goods assigned to another seller. But that seller does not accept legal title of the goods. It sells the goods takes their fee and remits payment. So if I'm the seller, my entry is going to be a debit to consigned inventory. And a credit to merchandise inventory. So essentially, all you're doing is creating another category. You have not recorded any expenses yet. When sold, the seller records based on what is remitted to them. So let's say we had a couch, and so you get a report in the consigning $1,000. $950. And so what you would get is you would get cash, $950. You'd have sales, $950. And then you'd have to get rid of the inventory. Sorry, this is debit. And you'd have to debit cost of goods sold or cost of couch. Let's just say it's 500. And then you would credit your consigned inventory for $500. There are other ways to do this as well. So you could put in 1,000 and then charge some sort of sales fees, but hopefully you guys remember from chapter 6 and revenue recognition that you should not gross up your sales when you do not have that amount in sales. And we'll talk a little bit about that throughout. Okay, any questions? Okay, so sales with returns. And here, if returns are expected and past experience shows a certain percentage or dollar amount is either stated or likely to be returned, then the seller should not record the full revenue. So for example, those $10,000 books and expects 20% return. So when they sell it, they debit accounts receivable or 80% sales, or 8,000. And then they credit sales for 8,000. Now, there are other types that you can do here. So you could do a debit for accounts receivable. And then again, this would be for 80% of sales. And so this would be 8,000. And then you'd have a debit to sales, returns, and allowances of 2,000. And then a credit to sales of 10,000. And so both of these will essentially, on the income statement, provide you the same thing. So first case, this transaction on an income statement. By the way, for now, I've just ignored any of the cost of goods sold stuff. But in the first case, you would see sales $8,000. And remember, sales and revenues are interchangeable. So if you use revenues or sales, they're the same. I don't know, but I tell people in this class, if any of you are English as second speakers, second language, sometimes the accounting, just the way we use English can be confusing. We use multiple words for the same thing. Think about a factory, right? We have a factory, we got a manufacturing facility, we got a plant. We have so many of these words that mean the same thing. If for some reason you come to a word that you don't understand, you can always ask me, even on an exam. Okay. All right, so in this case, the first case, you'd have just sales. In the second case, you would have sales, comma, net. And usually you would say something like of 2,000 sales, returns, and allowances. And you would report $8,000. So either way, you're reporting the same amount of sales. It just depends on how you do it in the system. And then, of course, you have to make sure, don't forget to account for the inventory. So in this case, what you would do is you would debit cost of goods sold, the cost of the inventory at the percentage of sales. So let's just say books cost $1,000. And so what we would do is we would take 80% of 5,000 would be 4,000, and that's our debit. And then we would also have a debit for expected inventory returns of 1,000. And then we'd have a credit to merchandise inventory for the $5,000. So what's happened is our inventory is only gone down by 4,000 because the expectation is we're going to get those $1,000. Any questions there? let's talk about product costs. Now, I think you've probably taken managerial or intro accounting too before the summer. Which means I don't expect any of you to remember this, but it was first discussed there. So if we think about what goes into products at a manufacturing facility, you have direct material. This is material. It's effective. You track into end product. Okay, so I know that's a little confusing, but if we think about a car, you're a manufacturer. There's some parts of the car that are worthwhile for you to track costs. Okay, so steel, right? The car steel. Perfect for teams because if you detonate. But then, so. Right? Gearbox, steel, that can cost some. It was worth it to track. Now. What about the 2 miles wire? Is somebody standing there going, oh, that's 1 inch, that's 2 inches, that's 3 inches? No, they're putting together a product and there's some fall off there, right? Like wood, that it's supposed to have exactly 5 liters, doesn't make it exactly 5%. No, the one is your close. So these are important costs that we want to track into the product. And we can do it in a cost-effective manner. All right, and then we have direct labor. These are the costs to assemble a product from raw materials. Only line workers are charged to direct labor. Supervisors, setup help, cleaning, and maintenance are not direct labor. Okay, so if you are working on a line and you're the supervisor in back, you're watching them do the job, only their hourly or salary wage will count. For the most part, by the way, we'll always assume it's hourly. And then your wage goes to what we call manufacturing overhead. Manufacturing overhead is all costs associated with the operation of the plant prior to and through the production of products. Except direct material and direct labor. So all indirect costs including indirect labor and indirect materials. So your utilities, your supervisors, these are all things that go into that one big pool. And if you remember, we used to use a predetermined overhead rate to price the parts. So we knew what direct material was, we knew what direct labor was because we could account for those quickly nowadays. We knew how employees work because the systems are so good now. We knew material because we know our has to have these important things. This other stuff, overhead gets assigned based on rates. Carl has, let's say, $3,000 in direct materials, $5,000 in direct labor, and then overhead is sent to a basic rate, and that can be various things. You guys can hopefully managerial account. Okay. All product costs are reported on the balance sheet as inventory, and remember, raw materials, work in progress, process, whatever, and finished goods. And the costs are expensed when the inventory is sold. We're reporting cost of goods sold. All other costs are period costs and are expensed they're expensed when they are used. So now, just thinking financial statements, what are some of the categories that you might see on the financial statements? You might see selling. And these are all costs associated with selling. And note, warehousing of finished goods is a sales cost. So up until the time that you make the product, all the cost is the product. Once the product is done, any moving products, any storing, those become sales costs. So you'll see things like distribution, shipping to stores, sales commissions. All that stuff will be included in this category. What else is included? What's the big expense in this category? It's usually advertising. Okay. Sometimes it's the sales salaries. Okay. Then you'll have general expenses, and these are generally specific expenses that the company has. So expense, investment expenses, and again, these are not the part of the operations, investment expenses. These are For example, I have, like, we talk about, one resident, we talk about his company, Berkshire Hathaway, they're sitting on $200 billion of cash, right? So what do they do with that? They usually temporarily invest it. But if that's not your operation, then you report that in general, fees and revenues associated with that kind of go into your general fund. The third category, administrative expenses. And so these are these are the expenses of the executive office and the professional staff. Accountants, finance, legal. Sometimes if legal's enough, they'll break it out into its own separate category. Sorry about that, the spaceship's landing, I gotta go. All right, kind of tells me how you guys feel about me. You're like, that guy could really get on a spaceship and leave. I said, I got the little buzzer and I said, oh, the spaceship's here, I gotta go. And everybody kind of went, is he really serious? Yeah. And so the last category would be other, and that's because they're these things. Sometimes you'll hear SG, A, and O. Any questions? Key takeaway? Costs. The expense. The cost of goods sold. Period costs. Are expensed. Paid or incurred. And accounting. If we think about some of these categories where the period costs may benefit you in the future. Let's think about, for example, and hopefully, even though there's some marketing people in here, we could agree that in general, marketing your product, advertising it will help you sell. So that's a future thing. How much does that help? That's a time quick. So that's really it. How effective your marketing is. What else is out there? So money matters, but also how do you track it, right? How many times have you been sitting there and you're like, oh man, it's hot, I need a fan. And something pop in your head and you'll say, oh, I gotta look for a carrier because that's a good brand or something like that. You know, because it's been advertised before. They have no idea what the term is gonna come back in the future. So basically, whenever your advertising period is covered, that's when you expect it. really marketing should be done in. Not only are you advertising, you're creating a brand name, right? You're creating some public good, hopefully, some good reputation. And if you think about it, Coca-Cola is largely just brand recognition, right? Recognizable companies in the world. Do they have something in their balance sheet that says Coca-Cola brand recognition? They don't. But I'll tell you what, if you go to a marketing class and you ask any marketing professor which companies have the most valuable brand names, they will tell you Coca-Cola's up there. But we as the governments cannot put some things on the books. We can't put human capital on the books. You guys remember Steve Jobs from Apple? So he was kind of their CEO, and then he wasn't their CEO, and he was back because they realized how great he was. And he got sick. And so immediately they stopped him. Because the guy, to the company, to the people that invested in him, was worth billions of dollars with his ideas. And so Apple can't put that on their books. So these are some things that can't be put on their books. And so one of the things that we do is, in general, if we don't know what's going to benefit us, we expense it right in the period. So we're paying salaries of Steve Jobs, that gets expensed. We're paying for advertising costs, that gets expensed. All right. What is the only category that kind of doesn't fall under here? Is just remember we're prepaid, right? If I prepay my advertising, I have one. You've already paid it, but what do I have after I pay it? And what's the advertising? If you're not sure, just always think about that assets equal liabilities plus my equity, right? This is how, and I know it sounds silly, I always go, okay, what happened here, right? So I took out $100 in cash, and I ended up with $100 in prepaid. So I'm just gonna abbreviate that prepaid DVD. Just say advertising because that's what we're talking about. So I still have an answer, right? I didn't do teaching. Is this entry correct, right? If we're looking at the entry form, I did the prepaid advertising for $100, and then I credit cash for $100, right? I still haven't passed that. So keep in mind, am I expensing that? No, I'm gonna expense it when it's incurred. So things like insurance, things like advertising, those are often paid in advance. So make sure that when you're thinking about what I should be putting it in as, you think about prepaids. Cash discounts, the gross method. So we're gonna focus on the gross method. And here, they tell you in the book that it's not the better of the two. So if you are an internal manager, you want to use the net method for internal. But you can use the gross method for external. Now, why are we worried about something like this? Because there's always this struggle between investors and managers. Who has the information on how the company is doing? Right? Investors and everybody else, except for banks, by the way, bank companies. But in general, we only get a look at the financials. So we are only seeing what they want us to see, and they want to use the gross method. And why they want to use the gross method? Because it doesn't show if they don't take advantage of things like purchase discounts. So under the gross method, when there is an option for a cash discount, company still purchase as though there is no discount. So debit purchases, merge inventory. Credit. It's payable. If paid during the discount, debit accounts payable, credit cash, credit purchase discount. Okay, real quick. How do we know if there is a discount being offered? Make a guess at this one if you think you know. So, excellent. So you look at the terms. And the terms will usually be and with that first number in this case is the percentage discount. Second number is if paid within these number of days. Now, keep in mind here, they kind of have to specify, say 10 business days, 10 days from delivery, 10 days. So just keep in mind that, you know, you're looking at that date on the question when you're being asked that question to make sure that they've paid. Okay. And then the last number in this case, 30 is when once it's due, if the discount or partial discount isn't taken. Should always take the cash discount if you're able. And you say, why? What is a 2% discount over 10 days versus a full year? And so just some quick math, assume 360 days or easy math in a year. And you say, okay, 10 days is so we have to multiply it by, it's a 1/36th is 1/36th the full year. So multiply the percentage times 36, and you get 2% times 36 equals essentially 72% discount annualized. Not considering compounding or anything like that, right? So the 72% over a year, pretty good discount, sure, it's 2% off. But you're essentially making a big return there. So you always want to pay the cash because for the most part, you're not going to be able to earn interest on that money that fast. Right? So pay it, get it over with, all right? Because it's worth it. And by the way, the entry, if no discount is taken, would be debit to accounts payable, credit to cash for the full one. Now, if you are an investor, do you have any idea? It is being discount, you don't. But under the other, they actually hurt, it hurts when you don't take the discount because it shows as discounts not taken. So you would have to report that somewhere on your financial statement. But our focus is going to be on the gross method. And the book says that it is because it's cost effective to do that. The real answer is because managers don't want to tell you any more information. They have to. If they're not being forced to by the SEC, then they won't. Now, this is a practice question for you. And this is not a quiz or anything like that. But like taking 5 minutes, like it take 5 minutes, go through it and kind of answer these questions. And report, typically reported as inventory in the financial statements. If it should not be reported as inventory, indicate how it should be reported in the financial statements. So goods out on consignment at another company store. The first example, these would be typically reported as inventory. Even though we would categorize it as consigned inventory. Okay, so take a walk through. You guys can talk if you're next to each other. This is not a quiz, it's just for you to see. Are you absorbing this? Teaching it well? Etc. There's no hard ones. I don't have the answers. Don't stay. Okay, so let's go ahead and walk through it. Don't worry if you're not completely done with it yet. Keep going. Okay, so what we want to do is we want to focus, typically be reported as inventory. So it's kind of a specific question. Are you going to report it as inventory, given the information that you have? And really you want to think about, okay, has legal title passed? And am I entitled to collect that receivable? And think about in the second one, an installment basis is essentially what? It's a note or some type of payment, right? So when you go and buy a car, unless you're wealthy, you typically sign a promissory note, some type of note like this to pay it off. And is that car still yours? Yeah. What's that? Yeah, well, so some states don't give you the title, right? The lien or whole thing. Think about if you crash it, who's responsible? Your insurance goes, here's $8, you go, I spent $20,000 on a car yesterday, and they're like, whoa, that's some miles, right? And then you go back and you say, well, the loan is still owed them 15 grand, and they go, oh, no, right, they don't care at all. So remember, these two things are separate, and really what we're saying here is that we sold goods on an installment basis, and it can be reasonably estimated, so we think that it's pretty good that we're gonna get paid for these, so we would report this in cost of goods sold. Not in inventory. Goods that are purchased FOB shipping point that are in transit as of December 31st. And so this gets recorded in inventory. Goods purchased FOB destination that are in transit at December 31st. No entry or report. This hasn't happened yet. When you get those goods, you'll report inventory and then an accounts payable. Okay. So this is a good one, but it's also quote unquote a bad. This is what companies started to do to make their assets and liabilities. Essentially, what they would do is either tell their distributors, who are usually separate, or tell a big financing company, we're gonna sell you something in December, and then in January, take it all back. And so essentially, this is a sale with a buyback option, and it's no sale. Because what you're trying to do is just dress up your income statement, where you're reporting a sale that isn't really a sale, and you're reducing your inventory that isn't really to be reduced. So if you do this, this is financial reporting fraud. So in this case, it gets reported in inventory. Number 6, goods sold where large returns are predictable. You're going to report that in inventory as estimated inventory returns. And now we're here, goods sold FOB shipping points. So even though this looks a lot like number 3, we have the difference of sold versus purchased. And so this is inventory. Freight charges on goods purchased, go ahead. Oh, I'm sorry, you're correct. Thank you. Good question. This is cost of goods sold. My apologies. Yeah. You know my toes. Freight charges on goods purchased. So we don't have timing here. We have to assume that it was during the period. Freight charges are shipping charges, and they're goods that you purchase, and these get added to inventory. So these are inventory costs. Okay. Okay. Because this is purchased, right?
It's purchased shipping.
It's included. Right, but you own it as soon as they ship it. Mistake, totally lost my credibility. Threw away my PhD. Freight charges, interest costs that are incurred for inventories that are routinely manufactured. So this would just be expensed. There are some cases where if you are building a large inventory item, you can capture those costs. So if you're making a skyscraper, a house, it may take you months or year to make that. And so any of the interest that you're incurring portion, and I can get it too. I think essentially it can be assigned to that inventory. But if this is standard practice and you just occasionally need to make a borrowing just because it's a slow time in the year, or do you think it's smart by borrowing inventory and selling it up to cover those costs, then that is not an inventory expense. That's just part of your general operation. So that would go into that big bucket of other administrative or general, wherever they want to hide it, depending on how material it is. Okay. Costs incurred to advertise goods held for resale. So we know that this is just expensed, right? Materials on hand, not yet placed into production by a manufacturing firm, just so you know, this is raw material. And is inventory. Office supplies. So this is important. This is not inventory, but is an asset. If they were to be factory supplies, they would be included in manufacturing. So that would become part of the product cost. Raw materials on which manufacturing has started production, which are not completely processed, so this is work in progress. And so this is inventory. Factory supplies, this is inventory. Manufacturing overhead. Goods held on consignment from another company, no entry. Right, it's their inventory. All you're doing is making a record, you have it. When you sell it, then you can make your entries. Costs identified with units completed by a manufacturing firm but not yet sold. So this would be finished goods. And that is inventory. Here we are again. Goods sold, FOB destination, that are in transit as of December 31st, and these are inventory. The last one, short-term stocks and bonds that will be resold in the near future. And these are short-term investments. Sorry. Investments. They're kind of going away from using short-term and long-term, using current and non-current, but I'm old. I did when I was 30. So occasionally, short-term, same thing, current. I think this example was in your previous, on a previous page. I don't think it copied through on the correct page. I apologize for that, but it kind of goes here. And so we have $840,000 inventory count. We have 96,000 just that were in transit. Shipped, FOB destination. And then we have 40,000 we shipped, FOB destination. So in this case, we include this. We exclude this. And we include this. So we have 840,000 plus 40,000. And so the answer is 880,000. For C. Okay, so example 4 is looking for cost of goods sold. So this is NAB's cost of goods sold is equal to 400% of selling expenses. What is the cost of goods available for sale? So every year in every class I have to do, I have to admit that I missed this problem on the CPA exam. And because I was going too fast. And so I needed to instead take my time. Which, by the way, you know that question, 99% of people got it right. I got 95%. So if I had got, right, I probably got the metal would be top grouping. But remember, when you're thinking about the cost of goods sold statement, it's typically you have inventory. So beginning balance of your merch. Inventory, and then you add your purchases. And this is what you're looking for. You're looking for the cost of goods available. If you want to go to the cost of goods sold, then you subtract out the ending balance in merch inventory. And that gives you your cost of goods. But this question is asking for cost of goods available for sale. Please let nobody on each make that dumb mistake. So what are we looking at here? We're looking at our beginning inventory. Have to work backwards. So. $520,000 is our ending inventory. And then we have to add to it our cost of goods sold, which is 4 times 460,000. That equals our cost of goods sold. Essentially, what we're doing here is working this backwards, right? So now I'll switch here and say, okay, I know my cost of goods sold plus my ending balance and inventory is going to be equal to my cost of goods available for sale. Okay. So all I did was rearrange this part of the equation algebraically to get an answer. And my math says that is letter D, 2,360,000. Any questions? Okay, so we're going to pick up here on the next class. On Thursday, so that'll be 9/5. Save that. And I don't normally do this, but I know people get nervous about what types of questions and things are we going to have on the kind of in class questions in the group. So what I'm doing is I'm hitting you out the first line do in class. Usually after we finish them. Now, if for some reason my teaching takes a long time, what I say is, okay, data, and you can turn it in on Tuesday electronically or in person. In this case, this requires you to work in Excel. So if you want to work with somebody else in the room, make sure one of you has a computer with Excel. And take a look this over, and you'll see the kind of thing that I expect to do in class or functioning class. I'm not trying to scare you, I'm just trying to make sure something comprehensive, kind of get you involved in doing what I teach straight. Have a great day. I'll see you on Thursday. If you have questions, please email me.